Hi, everybody. Hope you're all doing well. Been a little time since, I think it's been probably 3, 4 weeks since the last time I did a little presentation for everybody here. Tonight's topic, if I bring my umbrella, it will rain. Before we get to it, I just want to remind you guys, there is a lot of free information available at DTS. If you go to the home page and you click on the free stuff over on the left-hand side there, you can access a variety of things. The reason I do that very simply is because I know there are a lot of people who are interested in trading and not ready yet. Here's the site to the free stuff page. There's no catches on there. There's nothing you have to do or sign up for or anything else. You guys are already members if you're here. That's how you got invited. But just a lot of good information, from videos to other kind of documents and recordings of these past events and that type of thing. You could probably spend a whole weekend there. And I do this because I know a lot of you are just simply don't have the time or the funding, whatever, right now to be trading or investing more, but you're looking for it in the future. So there's a lot of great stuff there you can start to learn. And I also know a lot of you, it's human nature to want to try to learn this on your own first. I did too. I mean, I spent 6 months trying to learn on my own. And it's kind of human nature to want to, go out there and see what you can do on your own first. But it is tricky, and I never ever bother anybody to sign up or do anything. People kind of wade through the waters, and the people that decide that they want to get some help, they're welcome to it, and they ask. So free stuff page is out there for you to access whenever you want to, and you can comb through that and see all the stuff that there is you can do on there. So with that, let's begin tonight's presentation. The title. Interesting title. I'm not sure it's 100% perfect for tonight, but I have this concept in mind. I didn't know how else to title it. I'll get to what it means in just a second, because that's going to be the first thing we're going to do, is going to be discuss what I mean by the above comment, which is a phrase used in logic expression. I hated that class. I'll talk about that. It results in huge frustration for new traders and often hinders many not so new traders as well. Second, I will discuss why the general type of setup traders, investors look at is wrong, but it is very alluring. It's kind of a branch off from this. It's not exactly the same as number one, but it's in that same category of stuff. If I bring my umbrella, it'll rain. And then the third topic is not related. It's a little ancillary topic I'm going to talk about that actually I've waited 18 months to discuss, and I'm finally going to discuss it tonight. It's not so much an educational thing as a possible benefit for some of you. So hang around for that if you are going to be interested. This is specifically for day traders, though, this last thing. All right. I do plan on finishing up within an hour, as always. I think the first section will take about 25 minutes, second section maybe 15 minutes, third section 10 minutes. I'm not sure that all added up to an hour, but it's close enough. All right. If I bring my umbrella, it will rain. I don't know if you remember, like in logic class, I sort of remember that class for some reason. There was that expression, the if A then B. Does that mean that if not A, it's not B? And does that mean if B then A, and if it's not B, is it not A? All that, they called it modus ponens, nodus tollens, all this stuff. But I didn't really love that class, but I know it was made a lot easier for me when the teacher started to use examples about his umbrella in raining. I don't know if you ever had that or remember. You probably all had it, or most of you did, but you probably don't remember it because it was like one of those classes. I think I had to take it. I don't remember, or I got stuck in it. But it really is interesting. I'd probably like to take it now. I didn't enjoy it then, I remember. But the bottom line question is, if I bring my umbrella, it will rain. Well, what does that mean going the other way around? Well, before we answer that, 1,000 years ago, that's what it feels like. Let's get to that answer. And whoa, wait a minute, we have a chart. We're supposed to be answering the question about umbrellas and raining, and here we are on a chart. I don't get it. Well, let's look at a couple charts, and maybe the answer will become clear. I want to teach you guys a great strategy that I just recently learned. This is an incredible strategy. Anything that gaps up into the 200 period moving average on the daily chart is a short. And by the way, for some of you who don't know me, if it's like maybe the first time you're listening to me, don't tune out right now. Give me at least till the end of these next 3 slides or 4 slides before you tune out right away. Some of you that know me maybe know where I'm going with this, but I want you to check out this strategy. What a great strategy is. Boom. This is all just recently, last couple 3 days. Found some examples of this stuff. Boom. Yeah, this is Cody. You can check the chart for yourself. I didn't make this up. Gap to the 200 period moving average and boom, fell. Fantastic strategy. It works perfectly. Gapping up into the 200 period moving average, boom, top of that red bar. It fell all that the first day. It came back some, stalled here 3 days later. 200 period moving average is absolutely capping this stuff like you wouldn't believe. Third one, boom, look at that. Runs up, topping tail that day into the 200. The next day, big red bar down. Huge profits just from this very, very simple strategy, 200 period moving average. What do you think of that strategy? If I didn't tell you it was the 200, if I told you I had a proprietary trading technique and you could subscribe to it for $49 a month and it gave you those setups, what would you think of that? Oh, darn, I didn't bring any water with me. I have nothing to drink here. You're in? Well, if you guys like it that much, let me change the title of this presentation. For $49.99, send me your credit card info. We'll change this whole topic if you like it that much. I didn't know that was going to be that popular. Well, what's the point of this? Again, before some of you tune up, I know some of you are new tonight, so if it rains, I will bring an umbrella. Let's get back to this. Does that mean that if I bring an umbrella, it will rain? The answer is of course not. This is the logic question, and to me, in my warped mind, this directly relates to this topic because I've always had this from people, and it's something I've brushed on before in some other presentations, but I've never really gotten into, and I want to get into it tonight a little bit in depth because I think it really, really, really prevents people from learning. And this is, in my mind, this is a perfect correlation. I know it may not be, but in my mind it is. In other words, you can't make it rain by bringing your umbrella. And likewise, just because I showed you some examples, I showed you charts that dropped after they hit the 200 period moving average, right? That does not mean that all stocks that hit the 200 will drop. It sounds simple, and when we're sitting here talking about it in common sense, it is simple, but yet so many people get hung up on this. And how do I know people get hung up on this? Well, this is what I do. I mean, I have a lot of people that are subscribers to services. I have people that are members that ask me questions. I have strangers that email and ask questions. And I just know from the questions and the discussions I have when I work with people that this is one of the things that really hinders people. They get this thing in their head that, oh, this is a strategy. And I know it's a strategy because I've seen it work time and time and time again. Well, somebody showed you it worked, or you went out looking for the examples of where it worked and convinced yourself it does. But it's not necessarily true. Larry, somewhere in my notes I have the word Holy Grail tonight, so it's funny you would mention that, of course, but you know me. So let's continue to test that strategy. Gapping up into the 200 period moving average. Again, this is all just the last few days here. This is Facebook last week. And, oh, oops. Well, it didn't work that time, but it works most of the time, right? It works most of the time. Here's the next stop a couple days ago. MAS gapped up into the 200 and well, it works some of the time, I'm sure. This is an okay strategy now. So it went from great to okay. And here we go, gapping up into the 200, and oh wow, that went like really higher. Okay, well I guess maybe it works occasionally. How about this one? By the way, back before I get to this one, these 6 I just showed you, 3 that worked and 3 didn't work. It was really funny where I got these from. You know what I did? I keep my gap list from the last few days, and I just went back and I looked at my gap list, and I looked at anything around the 200, and I swear to you, I found 6 stocks in the last week, and there's probably 40 or 50 stocks that gapped. I found 6 stocks that gapped around the 200, and guess what? 3 worked and 3 didn't work, according, I say work in huge quotation marks, according to the strategy I just quote unquote taught you. In other words, I didn't go searching. It's not like, gee, this works, and Paul went and searched back 6 years and found 3 times it didn't work just to make some stupid point. No, this is just, ironically, literally, the last 6 trades, 3 worked, 3 didn't work. Now, if you were to go and look for a whole bunch, maybe you would find different odds. It's not that a 200 period moving average is ridiculous to have on your chart. I have them on my charts actually, but there's a purpose for us. a purpose for it, and it's not any kind of strategy to gap into it, around it, near it, by it, or whatever. In fact, look at this. Look at this next chart. It makes another good point. And also keep your mind open. I think most of you realize I'm not just talking about this one strategy of gapping to the 200. I'm talking about any kind. It's not even a strategy. I'm talking about any kind of a shortcut pattern where you're saying, look, when this happens, this always happens. We'll get to that more in a minute, but it's just kind of common sense. Here's where this stock's going to gap. I'm not even going to show you yet, above or below the 200. Do you believe, if you believe this strategy, it means that if right here, if this gap's over the 200, it's bullish. If it gaps under the 200, it's bearish, right? Does anybody believe in here for even a moment, even if you're really new, does anybody believe for a second that a 4-cent difference in the gap between 2 cents above the moving average and 2 cents below, does anybody believe that would really make a difference? Does anybody out here believe that that would make even a 1% difference to anything in the world? A stock is gapping up from $12 to $14.50. That's what, like 12, 14.5, 2.5. That's 20%, whatever it is. And the whole world's going to change whether or not it's 4 cents above some imaginary line that's drawn on the chart. No, of course not. What does matter? Well, number one, understand there might be some actual value to the 200 being there. What is the value to the 200 being there? What do we know? If we're gapping up a long ways into the 200 period moving average, what do we know about that? Is there any useful reference we can pull from that? Hey Mario, how you doing? Any usefulness we can pull? Is it just? I mean, if it's this, these are my real charts, and I do have it on there. So what's it there for? Right? Yeah, I mean there is some relevance to it. I mean, just for example, if we had to gap up a huge amount to get to the 200, what does that tell me? It tells me, well, this stock's really been beaten up, right? What does that mean if it's been beaten up? Well, it means a couple things. It means there's a lot of people who are long, who are in trouble, who are in pain. It could be those people that are exhausted from the pattern already. It could be that if it started back up again already, perhaps there are people who went long, right? Look at this pattern here. Maybe people, what about all these people that went long? This is kind of a quasi-strategy down here, right? What if people went long down in here? What if people went long down in here? What's going to happen when we gap up 20%? Well, if they went long, that's not a short squeeze. I just mean, well, yeah, I mean the people are short, but I mean people went long. You know, people went long. People went long. Look at this huge consolidation. Yeah, this huge consolidation. You buy something down here in the coming out of the ashes, and it gaps up 20%. Yeah, isn't that going to bring in a lot of selling, right? They'll be taking profits, right? What about people who looked at this and said, hey, you know what this looks like to me? This kind of looks like a sell setup, and they shorted it. And they said, oh, you know what, this is a bearish consolidation, and it's breaking down. And they shorted it, and they shorted it, and shorted. What are all those people who shorted it going to be doing when the stock gaps up to here? What are they going to be doing? You know, and if you're short and you're bailing, what does that mean you're doing? How do you bail out of a short, just so we're clear? How do you bail out of a short? You have to buy. Yeah, I mean, buying to cover, buying, it's the same thing to the market, doesn't matter, so they're buying. So we have people that have to buy. We have people that want to sell. See, what I mean is all this stuff is going on with real people, real price action. By the way, it's not just the wannabe traders and the small traders and the guy with 200 shares. This is funds. This is institutions. This is everyone else. This is everybody. You know, they're not that special. We call them the smart money, but I mean, they get trapped, they get stuck, they get caught, they lose. Matter of fact, the average firm on Wall Street doesn't beat the market, right? So they're not geniuses, they just have a lot of money. With all that stuff going on, do you think decisions are being made about this little line up here? No, and it's not being made about VWAP, it's not being made about, and most of the other things that people try to take and turn into pure strategies. Let's look at another one just for fun, as long as I have 5 more minutes. So this ended up going higher. But do you really think that would have changed if it had gapped down 10 cents less? Do you really think that would have changed this pattern? I doubt it very much. Here's another great strategy I found. I'm giving you 2 free strategies tonight. I had to charge you for both of these. Moving average crossover. You like those words? Doesn't that sound cool? Moving average crossover. That just sounds like a strategy in and of itself, doesn't it? It sounds like it makes money just saying it. Moving average crossover. Wow. Got all the cool terms in there. Moving averages cross, you get in long, boom. Guaranteed winner. Guaranteed winner. It works perfect. This is the market. This is the QQQ over the last few days. Moving average crossover. They cross, get in long, guaranteed winner. We have golden crosses, Mark. We have silver crosses. We have purple crosses. We have, reverse crosses, double helix crosses, all kinds of stuff. Moving average crossover, you would have shorted right there. Oh, well, didn't work so well that time. Matter of fact, you got really head slapped there for that one. But, that's okay. We missed one there. Next one. Next one here. Well, that says to short. You know what I'm looking at. I'm sorry. For those of you that are very new, let me apologize. I said moving average crossover. Maybe you don't have a clue what I'm talking about. These red and blue lines are the 20 and 40 period moving average. You can always, and I should have put that on there probably. It says 20-40 crossover. The one that hugs the price pattern tighter, of course, is the 20 because it's only averaging 20 bars. It reacts faster. So the one that's zipping up against the price is the 20. It's blue. The 40. And there's concepts out there. There are actual technical indicators. You know what a MACD is? Everybody's MACD, got to have that on the chart. It's a moving average crossover divergence. It's just simply showing the difference between two moving averages. It sounds so fancy, but all you're looking at is this. That's all you're looking at. And when they cross, some people think, oh, okay, the 20's been below the 40 all this time. When they're crossing, it's time to go long. Well, it doesn't really mean anything. Here it works a couple times. And by the way, here again, what I did was I went through the QQQ on a 5-minute chart for the last 4 or 5 days and just picked out the 4 times there was a clear crossover that wasn't, in the middle of a big gap or something between days like that. Here, if you shorted, so here we crossed down, you'd short here, and I guess you'd make a little money if you knew to go short, but then look at all the money you missed going long. And then they cross again up here. So you'd go long here after that kind of move. And some of you are looking and saying, oh, okay, Paul, you see what you have to do is that pattern's kind of whippy, or you need to get a smaller moving average that reacts faster. Ah, okay, all right. But if I change the moving average, though, to make this pattern work, do you think this one is still going to work? Do you see what I'm saying, everybody? So this becomes the next thing, that you custom fit these things to make the pattern you're looking at work, but it doesn't work for the others. A couple of simple things I can tell you is whether this applies to simple strategies or any technical indicator strategy falls in this category, all this stuff. That if there was something that worked that I felt was even a help, I would keep it on my chart. I would look at it. I would use it. I've been doing this a long time, and I'm not an idiot. I will say I'm not the smartest tool in the shed, but I'm not a blundering idiot. And if there's something out there that worked, I would use it. And there's not. This stuff, anything that's simple, just simply doesn't work. Just common sense. You're talking about the stock market game, right? Trillions of dollars, money passing hands all over the place, players all over. And do you really think that you can conquer this whole thing by, I have the moving average crossover in my back pocket. Nobody knows about that. It takes more than that. This is doable, but I'm just trying to get across to you that this reverse engineering stuff doesn't work. You can't make it rain by bringing your umbrella to work, is my silly analogy for this. Let me know if you have any questions. I'm going to take a quick look at a couple notes I had written here to make sure I said the things that I wanted to say, because there were a lot of things as I ran through these slides. Okay. Explanation. Why did that work or not work? Well, Paul, you have to switch over to the exponential moving average, or the 8 must cross the 13, or it must be a different time frame, or maybe you have 3 of these, right? You have a 5-minute chart, a 15-minute chart, and this chart, and 6 different pairs of moving averages, and when they all correlate at the same time, then that's the time to go. Guys, there's no magic shortcut to it. I mean, people have been working on it for forever, and it just simply doesn't exist. Period. I make the statement. Nobody can prove that wrong. You will never make money with concepts like this. It's natural and human, and even a good thing to explore all the things you want. I'm not even condemning this. I'm just simply saying keep your mind open as you do this. People like to go through and try all this stuff, and I think it's good to prove to yourself. That's what I had to do. You had to just prove to yourself, the things that don't work. I'm just asking you to keep an open mind and look at that. If you're testing something somebody told you, don't look at the 6 times that it worked. Look at every instance of what happened, and then see if it gives you any kind of aid or not. Nothing's going to work all the time, but something may give you a little edge, advantage, some kind of extra aid to you. There's a lot of different ways to make money in the market, and we can all look at things differently. And I am, a very open person to say there's a lot of different ways to do this. But all I really ask and try and get across to you is that you have your way, whatever it is. Because I want you to remember, the vast majority of people who come to do this lose money. The vast majority. And you have to be different than them. And coming out with some of these ideas like I just showed you is not being different, it's being part of the status quo. The reason I get into this a lot is because, like I said, I get a lot of emails from people, and they are kind of justifying what they're doing all the time. Now, when people that take my seminar program, when they email me, I get very mad if they do not speak in seminar terms. You paid for this class, you're learning this great stuff, you should know how to speak the lingo and understand what's going on. And I get mad if people take a trade and then they come back and they start justifying it by saying, well, the weekly chart kind of looked like it wasn't going lower, and the daily chart, I could tell that a lot of buying came into it, and they just make these random comments. And that gets me really upset if somebody has taken a seminar and hasn't really adapted the concepts in there. It doesn't get me upset when actually if somebody who is new emails me, and this is where I get this a lot, is people will email and they will come up with things that amaze me. And I'm going to tell you this conversation I had with somebody. I'll give you the basics of how it went, and you can maybe appreciate it. They said that they had devised a formula to put on their charts, and it had to do with when stocks gapped, and it would tell them when a stock that gapped down and rallied was ready to short, or when a stock that gapped up and fell was ready to go long. So I'm like, okay, you're showing me 4 or 5 examples. Those work great, but I really don't think it works all the time. So I gave some other examples of stocks that gapped that day, and I said, look at these, they fell and didn't go up. And they said, well, they didn't trigger my system. I said, okay, what's your system? So he sent it to me. So I put it on my charts. So a few days later, he says, look at how great this works. Here's 3, 4 stocks that work. Well, now I had his system, right? So I looked at all the stocks that gapped that day, and he had 2 or 3 that worked, and there were 7 that didn't work. You following along with me, right? Because now I know what he's looking at. He told me, Paul, here is my system. Here's what I do. Boom. Here's 3 that worked, but now I was able to have the ammunition to come back and say, okay, here's 7 that didn't work. And what do you think his response was? What do you think his response was? Send me his little formula. And by the way, little formulas that go on charts are not exactly new things. They've been around since the beginning of time. Well, Glenn, you're very close. You're right, I was wrong. That's coming, Glenn. But the next thing was, because on those, the 8 exponential period didn't cross the 20 exponential period. And I said, what? Oh, on the 2-minute chart. I said, what? What didn't cross what? Oh, that's part of this now. Oh, yeah. Yeah, that's part of it. Yeah. So this formula has to trigger, and then after that triggers, then you need the 8 to cross the 20 on whatever time frame. Oh, okay, all right. So I stuck with it, right? So the next time, look, Paul, here's 4 or 5 that worked today. I said, okay, here's 5 or 6 that didn't work. Again, with the 8 crossing the 20, just like you said, blah, blah. Oh, guess what he says next? I'm not even going to have you guess. Oh, well, you know what? All that happened above the VWAP. You guys know what the VWAP is, right? It's a very wacky anticipation process. No, it's this volume weighted average price. It happened below the VWAP. You can't take those. Oh, now we have another qualification. Oh, I didn't know about that. Okay. I'm not joking with you. I just want to get across to you so that you don't fall into this trap. And then the next step is same thing. Here's Paul, here's some trades that work. Come back. Okay, here with your formula, with your 8 crossing the 20, with your VWAP, here's 5 that didn't work. Guess what? I'll make you guess this one. Guess what the next comment was? Because this really puts the icing on the cake, and this is the trap I don't want you to fall into. Sir or ma'am, your formula triggered, the 8 crossed the 20, you're below the VWAP where you want to be, these didn't work. How can you justify your strategy? Anybody got it? Thanks, Jackson. Well, and some of this, I get educated, not necessarily to be a better trader, but to be a better teacher, Jackson. That's what part of this is for me, to be a better teacher at some of this stuff. The next thing was, and I'm not kidding you, well, no, that's not it, Jim. I didn't like what the earnings report said. I didn't like what the, and at that point I'm like, come on. I mean, and what this amounts to, everybody, is just you just look at the chart and you decide you like something and you start justifying it with whatever you need to. You have 1,000 different tools you look at and none of them make sense. None of them correlate together. They're just random things, and you say, hey, here they come together, and I'm gonna just take this trade and I'll start justifying it. So you can't do that. You will never make money with concepts like this. It's natural and human, and even a good thing to explore all the things you want. You will never believe what works until you prove to yourself what does not work. Everyone likes a deal, likes a shortcut, but there is none. It's only great technical understanding of charts, of technical analysis, that will have you successful, learning the language of charts. And something I'm big on is sometimes people will say, well, gee, Paul, you've been studying this a long time. I mean, what will it take for me to become your level? You don't need to do that at all. You don't need that. You need to find your niche. You need to understand charts in general well enough to know the whole universe you're operating with, to know what's out there. You want to make sure that you don't get into the trap of, the grass is greener on the other side. In other words, you're trading something, you come along and somebody shows you something else, you go, oh, what's that all about? You want to be able to kind of have your hands around everything that, that kind of works, doesn't work. And then you just kind of specialize in one thing. You just specialize in something. You become an expert at one little thing. And I've had so many of my students that really, at the little area they focused on, they became better than me at it, because that's the one thing they focused on. And they look for a certain pattern. By the way, the concept I just said is not exactly an ill-gotten concept. As a matter of fact, if any of you ever read the book called New Market Wizards by Jack Schwager, he sets out to study 25 successful traders with the goal. He's not a trader himself. He's a behavioral psychologist, I think. And he sets out with his goal to just find out what they do in common. What do they have in common? Well, he found out what they had in common was that between all 25 traders, they had nothing in common at all, strategically. They did nothing the same. The only thing that was in common was that while they all had their unique little thing, they all patiently waited for their one thing to happen, whatever that was. And it completely agrees with everything I think about the market. There's a lot of different ways to make money, but you have to become an expert at one of them. Not at all of them, not at everything. You don't have to be a jack of all trades. All you need to do is pull off a couple good trades a day as a day trader, a couple a month as a swing trader. It's all you need to do well. You don't have to do 700 things. Now, there's different styles. And you can certainly have a great style being more active and doing more things, but you don't have to conquer the world. You only have to conquer a couple different styles that you want to do, things that you want to do. Don't get me wrong, I have moving averages on my chart, but they're there for a purpose. They are never entry signals, never are any kind of technical indicator, period. If you want to test a concept, you must test every issue over a large group and see what works what percentage of the time. I've done this to many things over the years. You will find that there is no one thing. It is a combination. You have to find multiple things to get the odds in your favor. This should not be a surprise. It should not be a surprise. Everything in life operates this way. You don't win a football championship with one great play, right? What if Tom Brady went out there every single play and threw a slant pattern? Slant, 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 slant. Wouldn't work, right? You need a combination of plays to have a great football team, to win. Sure, you can win a game with one surprise play. Great, but you can't do that game after game after game, right? You need a balanced concept of what you're doing. You don't win a case as an attorney with one great closing statement. You don't go up there every single trial, regardless of what the facts are, regardless of what the situation is, with the same approach and do the same thing all the time. It's not as simple as just having one cliche line that you say. There's no such thing in trading as having one cliche thing that works on all the charts. Bottom line, you can find examples of anything you want. Others can show you something that works, but because all of the examples, you can find examples of anything you want. Others can show you something works because of the examples of how it works. But under that theory, lots of things work. If you take your umbrella to work, it won't make it rain. against the Bears. Good one, Don. Especially me, originally from Chicago, like it. All right, so that's the first section. Maybe for some of you it was incredibly useful. Maybe for some of you I was beating a dead horse. But again, as beyond a trader, just being an instructor and trying to show people this, my goal is to really get a lot of people to understand this and be successful. I'm feeling very good about that goal, as I'm getting a lot of people that are really, doing well and getting this. And my goal is to try and stamp out some of the problems I see. And again, I'm talking to a group of people. There's a big group of you here, and you're not my seminar students, so we're not talking about the details of 25 hours of talking about charts. We're talking about some of the problems, some commonalities, some things that you have to, to work on as you're trying to learn this on your own, or if eventually you do take a seminar program here or somewhere. Because these are the things I see hurt people, because when your mind is closed to what is right, you have a hard time learning it because you're stuck on old ideas. Okay? This next one, it won't well, it's not hard to make it rain in Western Washington. You can do that, I think, by just sneezing, right? Pretty much. Setup. Most look for, in general, it makes things very tough. This next section will go a little bit faster. This is just kind of almost a side topic, but to me, again, it's a big thing. It's kind of related to the first one, but a little bit different. What's the topic in general? The thing that makes people, the people are attracted to, but yet is really the wrong way to be going. And this is a big general conversation, not a specific one. Well, most traders, when they learn basics of some setups, are drawn to the flashy ones, the home runs. That's Babe Ruth down there. And I don't know, a few months ago I mentioned him in a presentation as well. Babe Ruth, as you know, for a long time had the record for most home runs. He also had a record for something else too. Anybody know what that was? His home run record is eclipsed, and I think his other record is eclipsed too. I'm pretty sure it is. Right, he had the most strikeouts. Most strikeouts too. Does that make Babe Ruth a bad player? No. Obviously, he was a great player. And there's nothing wrong with going for home runs as a trader either. But here's the difference. What if, let's say Babe Ruth struck out 3 out of 4 times at bat, and the 4th time at bat he had a home run. Would he still be a valuable player? He wasn't quite that bad on strikeouts, but even if he was, would he still be a valuable player? If you got 1 hit in 4, but it was a home run, would he be a valuable player? Anybody who knows anything about baseball at all? Sorry for the baseball analogy for those of you who are clueless as to baseball. If you come on, yeah, of course, you're batting 250, but it's a home run, right? If you got a home run every 4th time up and an RBI every 4th time up, more than one RBI, whoever's on base every 4th time up, of course you would be the highest paid player in baseball. You'd have how many? You'd have 162 home runs every year, right? Fantastic stats. But here's, if you want to take this analogy to trading, and this is a very, very real analogy. What if Babe Ruth, when he hit the home run, what if he rounded first base and went in the dugout? Or just stayed on first base? In Major League Baseball, if you don't round the base, it's not a home run. I mean, you could literally give up his home. What would happen now if 1 out of 4 times he got a single? Is he still a Hall of Fame player, Steve? Still batting 1 in 4, but instead of a homer. Nope. Matter of fact, he's probably going to get sent down to the minors, right? And that's the trading analogy, is that there's nothing wrong with this trading style where you're going for that big winner, that high reward to risk trade. And maybe you only get it right 1 in 2, 1 in 3, 1 in 4 times, but it's a home run. That's great. But what do most traders do when they get the home run? In other words, they take a loss, boom. Let me put it on the screen. They take a loss. What are you risking? Let's say $300. You take a loss, boom, you're down 300. You take another loss, you're down another 300. You take another loss, you're down 900, right? And then you get the home run. It's going to make you $2,000. But what happens when you get up to $800 of profit, everybody? Many of you have been here. You have 3 losing trades in a row. The big winner comes along. You're up about $800, and what do? You say, hey, if I sell this now, guess what? I'm back to break even, and I can start over, right? 2 questions for you. Number 1, do all of you see how that is a system that is guaranteed to prevent you from making money ever? Do you all see that? It's not a bad habit. It's a guaranteed losing system. If you were to create a system for somebody to lose, there it would be. Go for the home run, and when you get the home run, just head for the dugout after you're on first base, because we don't want the home run. And yet it's very difficult psychologically, especially as a new trader, if you get down, to hold on to that position because you got to make 2K out of it, because that's what your plan is, right? I only get 1 in 4 right, but when I get it right, it makes 5 times what I lose. Okay, great. But you better have a system and process where you get those profits. And you know what? Nobody does. And this is the other thing I see all the time. Just, we're all friends here. Nobody knows anybody with a first name. Just give me a 1 on the screen if what I'm saying to you just relates to you 100%. Like, gee, whether it's day trading or swing trading, I'm just kind of break even because, yeah, I get a couple losses and then I feel compelled to dump that next winner because I don't want to be negative that long, right? It's one of the most common problems I see in trading, right? And sometimes it's not, you may not even have a technical problem. You may go back and look at your record and say, hey, if I would have done this right, I made money, but I didn't do it right. Now, here's what part of the problem is. I'm going to give you part of the answer right here. Here's part of the answer. Number one, you can design a style where that's what you're trying to do. That's fine. But the other problem is a lot of people don't consciously try and do that. They go after the wrong setups, and that's what this section is about. And here's an example, right? People are drawn to these, right? People are drawn to these. Let's not get too technical. I did not look long for this chart. I looked like, 3 minutes, so I didn't necessarily get the best example. But why are people drawn to these? Why are people drawn to these? And this would be like a buy setup, of some kind, right? They're drawn to these because we had this big, huge move, right? And then a big pullback, right? So you're thinking, man, if I get in here, look at this little thing, and all I have to do is make a new high, and boy, I'm making 5 times my money, and blah, 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 blah. I've heard that before, Jackson. Sorry, a little temporary laughing for Jackson. Sorry, but what's the problem with this? What's the problem with this pattern? Is the typical thing that you jump in here on this big, and the issue I'm getting at this big wide pattern, this big wide volatile pattern. We have this big move up and this big move back. When you get in this, does it typically just fly higher? Is that what happens typically? No, because with this, the allure, the flashiness of this pattern comes some problems, and that is the fact that you have a lot of people who have been in this long, who need to take profits, want to take profits, and when this falls, they don't take their profits. Guess what they want to do? When it starts to pop again, boom, they come in and take profits. And what happens is, a lot of times, and I'm sure this has happened to you, you're in this thing, you get stopped out, like what would have happened here, you'd be stopped out, and then it may go on to work. Maybe it works, maybe it doesn't. Not really the point. The point is that you're, as kind of a newer player or a less experienced player, you're going after stuff that's over your head, trying to get this home run out of this. And the problem is this: you can't get in here. Go back to you can't get in here with precision because you're never quite sure where it's going to bounce. This is not a good setup, by the way. If anybody ever sent this to me, I'd say I would not take it here or on this green bar, because there's all kinds of problems with this chart that I wouldn't trust or want to do it. This pattern ended up I didn't actually expose the whole chart for you. I forgot. I don't know why, but it does end up going higher eventually. But what good is it if this goes to new highs if you're not in the pattern? Do you understand what I'm saying? Guys, again, give me a 1. How many times do you look at a chart and say, man, that chart did great, but I wasn't in it because I missed the entry, or because I got in the entry, got stopped out, and then it worked after I got in, and son of a gun, I was right, but I'm not in the stupid place. See, this is all part of the game. It's all part of it. And you can't just look at a chart and say, oh, it worked, but I had bad luck. Oh, the stupid HFT shook me out, and oh, my spouse came in to talk to me at the wrong moment, and oh, this and all that. It's all part of what it is. Right, Thomas, it's all a reflection of reward to risk. And that's kind of the point I'm getting at here, is you don't have to go after these big, huge, sweeping patterns, because the focal area to get into this becomes very difficult. It'd be difficult for me. Thanks, Don. So it doesn't matter what move is coming if you're not in it, right? Now, there's some things people do to do this. They can compensate with a huge stop, right? But then the stop becomes so big they may not make much money at the top, right? Or they may stop out frequently. You keep trying it and trying and trying it, which is not necessarily bad if you can prove that the patterns you're taking do develop big winners sometimes and you hang on to those big winners. But like I just asked all of you, do you ever do that, right? Why is it difficult, Gladys? Because you do not know where this is going to stop falling. In other words, this would have stopped out, Gladys. If you got, and I'm using some just traditional concepts people look at. This green bar came and took out the high of some other bars. If you would have got in, it would have gone under the low of that bar down here, and typically people would call it, and I'm not even teaching it or saying what's right or wrong, I'm just saying this is a pattern that people get sucked into. The problem is you have no precision, and maybe if you look at the next couple of slides, you're glad to see, the tighter patterns are the ones where you have precision, okay? Now maybe you don't have that huge sweeping move, but you know what, you don't need it, because you can get in with precision. Does that make sense, everybody? If you can get in with precision and the stock moves twice as much as the room you gave it, your stop, you're making twice your risk. You're making more than, as a day trader, you're making more than you need to make in a whole day. You're making your whole day's profits. I mean, you're done. You don't have to go for these big sweeping moves. And the great thing is that you can become more accurate and yet still get the profit. And some of these, even though they're tight patterns, they continue to go higher. Is it because as far as, well, yeah, back to this one. Well, Gladys, here, look at this chart, right? That's a tight pattern. In other words, you can really start to predict well where some of these entries will be. And I'm going to show you, let me show you another one here too. Is that, yeah. Here's another, here's a daily chart of a stock, and this is what I call a tight pattern, Gladys. And then if you come down inside this tight pattern, here's the hourly chart. In other words, these areas become much more predictable where something's going to pull back to because you have just a smaller range. And yet you can still have really nice moves because you're in this very, very, very strong pattern. And yeah, when you're back on this chart here, exactly, we don't know, Gladys, this could pull back to here and still be bullish. It could have only pulled back to here. It could pull back to here, bounce, fall one more time, and then rally the next time. It's just become unpredictable because you have so many people that have already bought this and that are looking to take profits. And it doesn't even matter why it's happening. It is happening, and the pattern is wide. And it makes it very difficult to either, if you try and use a precise entry, you will stop out a lot because this pattern is not precise. And if you don't use, and if you do use, if you give it a lot of room, which is what you need to do sometimes, well, then you've washed out the effect of taking this more volatile stock because the big move you're having is neutralized by the fact that you have to give it more room on the risk side. In other words, I'm assuming most of you have attended or heard me talk before or attended the half-day seminar event that you all get to attend on the Fridays that I do it, where I talk about that, you know, you can't even measure a trade unless you measure what you're risking. Because you can't just hang on to a trade and be willing to lose $2,000 on one trade and only $200 on another trade just to make a trade work. So to manage your risk, there's a limit to what you can do, and patterns like that become very, very difficult. So these are the tighter patterns where you have better odds of doing things. And I just threw this in there this afternoon because I was thinking I wasn't really going to put stuff in here from recent trades because it's more of a theoretical thing, but this is a trade I did today. Do you see this tight pattern, Gladys? Do you see what I mean by this? I shorted this today right there. Do you see that? Right there, 33. And there's 33 under 33.58, and that's right there, just coming off that topping tail. Do you see how this is precise? I mean, look at this downtrending pattern here, right? Every morning it rallies up and boom, and that's what I look for, Glad. That's what I look for. Now, I'm not saying everyone has to. I mean, there's stuff I teach, and I think there's right and there's wrong. But then there's a whole variety of avenues you can go down, you can go down to kind of complement your style or what you like to do. This is what I like to do. I like to find these precise little things and find a spot where I say, okay, you know what? For lack of a better term, I'm willing to bet that once that tail starts to form, it's not going to go above that prior day's high. And you know what? It's a pretty good bet. And look how precise that is, right? And this went right to close. I ended up closing out the back half of this right into the close at the end of the day. So it's not even, at the time I did these slides, it wasn't even finished. I was working on this while I was open. Okay? So big advantages. Many stocks have all the volatility you need if you know how to play them. You can take any stock, guys, any stock out there. I mean, maybe a few exceptions. There's some really, really boring stocks. But if you look at the top, 500 most volume stocks in the market, I mean, 95% of them have all the volatility you need to make money on whatever time frame you're on. You just have to have more precision in what you're doing. With more precise pattern, you can have more aggressive and reliable entries and make more money with reasonable targets. You don't have to get something going off the chart, putting on the biggest rally in history. It's increased profitability and reliability, but it is boring. I call myself a boring trader. People in my trading room are usually bored because they're not doing 7,000 things. All right, any questions? If not, I want to get on to the last topic. I have 12 minutes, just about the right amount of time for this. Any questions on these technical topics? Because the last one is not really a technical topic. It's one that could prove to be very helpful for some of you. It's an answer to a question. You can't be precise if you choose to trade. No, it doesn't matter, Jamie. It doesn't matter what time frame. I used an example there of an hourly chart you just saw. This is an hourly chart, but up here I showed you a daily chart. You can find really tight weekly patterns and then find entries on the daily chart, a very contained range on the weekly. And I'm not saying that's all you have to do, Jamie. I mean, I'll do some other patterns. I'm just saying that is where you can get more precision. And people are drawn to these big, sweeping, huge moves up, then huge pullbacks. And you could be a mile off on where that pullback is, right? We just don't know. I don't know. People ask me sometimes like, well, it might rally from there, but I really don't know. I don't like those patterns because I like to be more precise, okay? And inside, yeah, well, by definition, if I'm getting a lower high on the hourly chart, it was inside the prior day, yes. True. Okay, let me get on to this next topic, which again is something I've not talked about yet. This is about, and this is only for day traders. If you're not interested in day trading, you probably don't care. If you're interested in becoming a day trader, or if you've been trying to day trade, or if you have been day trading and you're having a problem with capital, this is a topic that I have not talked about because I've not had the confidence in the place to do it with until now. I'm sure most of you are aware of the fact that there is a rule for day trading. You have to have $25,000. This was enacted back in, when was it, 2001, a long time ago. Yeah, that's a good question. What is the purpose of that rule? That's a really good question. Let me give you my personal take on this a little bit, because I'm not, I like rules. I think they're good things. I like our government. I think they do good things. But a lot of times things are really screwed up. And the purpose of this rule was to protect traders. And since I live and breathe this concept every day of my life for almost 20 years, I have to tell you this was a poorly founded rule that is hurting people way more than it's helping people. What the rule is, let me just go over the rule real quick. It simply means that if you try to open a day trading account, you know that if you have less than $25,000, you cannot day trade. In other words, you only have 2-to-1 margin, and your money's not recovered for 3 days. In other words, if you sell something, you have to let it settle for 3 days before you get the money back. As a day trader, you get 4-to-1 margin, and it's instantly renewable. In other words, if you put $25,000 in an account, you can buy $100,000 worth of stock, sell it 5 minutes later, rebuy it again 5 minutes later, sell it again. You can do it over and over and over again instantly. So there's a huge difference. And it used to be before the rule that any amount of money you could day trade with. And it was just up to the broker what they were willing to deal with you. Typically people will take $5,000 as a minimum account size. Well, they instituted this to protect people from losing money, but it's had the reverse effect. Because what has happened is that people have been forced to try and attain more money by mortgaging houses, getting loans, whatever it is, and then they have this large account sitting there, which, I hate to say it, a lot of people will blow through. I mean, they have trouble when they start off, and then you have this money in front of you, and you try and get it back, and you get out of control, and you blow through large amounts of money. And the understanding of this, I mean, I just, as an aside for a moment, you can say, well, how could people do this? I listened to, when they were talking about a gun control rule, I listened to a woman congressman talk about it. And she was the one who was promoting some kind of a rule about limiting gun controls or something. And they were talking about magazine clips. And she is saying, well, if we just stop manufacturing these, we don't have to worry about it because when they get shot out, they'll be gone. as if it was a bullet. In other words, she didn't understand what a clip was. She's making a rule, she's making a law for the American people, and she doesn't even know the components of a gun or how they work. And this is what it was like with this rule to some extent. I mean, the people making this, I heard people talk and debate about the short sale rule, and they're clueless. They don't even know what they're saying. They're making the laws, and they don't know what they're saying. And I think it was the same thing here to some degree. But anyways, I don't want to belabor this, which is the first time I'm doing this. I just want to introduce you somebody to the topic of what's going on. And it's become a big thing for a lot of people because these people, a lot of people want to day trade, and they're cut out of it. Or some of you may be in a position where you started with $25,000, $26,000, $27,000. You lost a couple grand, and guess what? If you're at $24,999, you're done. Right? You're done. There is no reprieve, and you have to put more money in to get back over that. So naturally, it led a lot of people to try and say, what can I do about that? Well, the other problem that happens is, number one, people either try and obtain money by borrowing it, or when you borrow money to put an account to day trade, you have 2 strikes against you already, right? You have 2 strikes against you already. Yeah, exactly, Don. I know. I mean, that's what I'm saying. It's an ill-founded concept. And when I get to this in a minute, I'll explain the other side of it. But what I'm going to say basically is, if you're going to try day trading, and if you're going to blow out an account, why not blow out $2,000, $3,000, right? Because then when you have to reset and re-put in, it makes you stop and think and recalibrate. But when you have all the money in the account, a lot of people, I've heard these terrible stories where they just get mad and they get frustrated, they start doubling down, and boom, an account's $100,000 is gone. And and that's what's really scary and what I hate to hear stories of all the time. So, but the next problem is what some people do is that they don't have the money. Then they decide to do a couple other things. They decide to go to swing trading instead of day trading, and try and maybe build the account back up. Has anybody been in that situation? Well, you may not want to volunteer, but maybe you're over 25, you lost a little bit, and you said, okay, I'll swing trade my way back to over 25. Well, swing trading is the worst time frame to be learning on or goofing around with. I have a whole video on this, by the way, which talks about the swing trading time frame. I like long-term time frames. Don't get me wrong. I understand my terminology. Swing trading means holding for several days based on the daily chart. And I like day trading. I like longer-term trading, weeks, months. The swing trading is a very difficult time frame. I explain why in a video. You'll find it on there. It says something about time frames. 2 time frames to be aware of is the name of the video. So that causes problems because then people are forced to swing trade and they lose more money. Some people try to go and trade futures and Forex because futures and Forex are not subject to the day trading rule, which is only for stocks. Okay. Now, there's nothing inherently wrong with trading futures and Forex, but there is a big problem I want you to be aware of. Number one, you should be trading what you want to trade. And number 2, futures is one thing. In other words, when you're trading stocks, you have 100, 500, 800 stocks that you can pick from. And if you don't like one, you go, this is what I love about stocks. And while I trade futures sometimes, I couldn't do it full-time only trading futures. Why couldn't I think this would be a good question for some of you guys. Why can't I only trade futures? I do sometimes, but I cannot only trade futures. Exactly, Glenn. I don't have the patience. Now, some of you have called me a Satan god of patience. I don't have enough patience to do it. Because, right, there's one setup. There's one thing. Futures, Carmen, are just, you're playing the market. Well, there are futures on all kinds. There's futures on corn, cotton, but there's futures on the S&P stock market and on the NASDAQ stock market and on the Dow. So you're playing the market with a very leveraged instrument. That's all you can play is the market. So, I mean, if you miss your chance, if you don't like the setup, you're done. That's all there is. And Forex, the same thing. Forex is a little different. You're trading a few pairs, but there's a handful of things in Forex. And if you don't like the handful of things, you're out of luck. And also Forex, the prime time is really early in the wee hours in the morning, and the market never closes for both of these, so you don't get gaps. There's a lot of things I personally don't like about either one. So I really would not like to be doing those. But a lot of people resort to that. Well, Carmen, yeah, technically there is a futures chart, but it's lockstep mirror image with the QQQ and the SPY. Yeah, you could look at either chart you wanted to. The numbers would be different, but they'd be exactly the same chart. Yeah, you could actually trade the futures and look at the QQQ or SPY if you wanted to. It wouldn't matter. I mean, the Qs and the SPYs are different sometimes, a little bit, but the S&P futures and the SPY would be the identical chart during market hours when it's open. Okay. So again, this is the problem that it leads to, is that people are forced to do something they don't want to do, and it can be a problem. And I know a lot of people resort to doing this. So the bottom line is, don't be forced to do something you don't want to do. The majority of people who throw some money in an account for Forex or futures, trade, lose the money, refund the account once or twice, and then they're done. So again, if you want to do that, that's fine. I'm just saying that for most people, if you don't want to do that, you shouldn't be forced to do that. So there's an answer. So now a lot of you here have never heard of what I'm about to talk about. This is brand new to you. Some of you probably heard about it and you're not real sure about it. There's an answer out there that's a legit answer, has been around for a while. It's called proprietary trading. You may have heard of this term. It's where someone starts a larger account that is a large day trade because there's a lot of money in it. And then you get quote unquote hired to trade part of that account. And you put up money to cover your losses. Now proprietary trading, there's kind of two versions of it. There's real proprietary trading that takes place on Wall Street where firms hire people to trade their money, and if you don't do well, you get fired, of course, instantly and immediately, and you have to have an incredible track record. But Goldman Sachs is proprietary traders and whoever, and that's where the term comes from. But the second use of this was, hey, let's open an account and let's let all these people who want to trade for themselves trade for themselves. And while you're quote unquote, they call it being hired, but really you're not hired. You're just, instead of having to make money for the firm, you're making it for yourself, and you put up a risk amount to cover your losses. A great way to, kind of get around this. I started DTS in 2017 with a goal of truly trying to turn the corner for many as long-term traders, investors as I could. There's a problem I keep hearing a lot. People want to day trade, but they don't have the 25K, or they had it or are now below that level, and they've come to me for recommendations. And by the way, there's a lot of people out there too that I think have long-term investments. They like to day trade, but they don't want to sell off what they have or whatever. But if they had the opportunity to day trade, they could. Okay. I want to provide every service I can, and this has become a big issue for those that want to learn to day trade. I've been vetting a firm for over a year, since last year, and I believe this is the solution for most. As you know, I've been around 18 months, and I have not yet ever recommended anything. And I am proud to recommend a firm that has these highlights. And for those of you who have looked around, you have a $5,000 deposit, 10-to-1 leverage, and that there's no track record, experience, or anything required. You get a 95% payout immediately. Yes, 95%. That's the correct number. Not 65, not 45, not 75, 95. You can be trading your account basically almost immediately. I mean, you have to fill out forms and send money, but other than that, it's almost immediately. You will be trading real money. If you don't even know why I'm saying that, then don't worry about it. But you're not going to be on a simulator unless you want to go on a simulator to practice. But you'll be trading your real money on day one or whatever you want to do. The platform is a Sterling platform. It's a top-rated platform for traders. At the end of the year, your income is reported on a 1099. 1099. And here's a couple of big ones, guys. Your money is held at Chase Bank in New York and is FDIC insured. But yet the account is not in the U.S., so it is not subject to having to take any exams or any of the other stuff. So a couple of things people immediately say are, I'm worried about whatever. Well, it's FDIC insured at Chase Bank. And the other catch that often comes up is people like me would say, well, okay, to do this, you got to take this education program, and it's kind of an entry fee. I'm not here to do that to you. You guys know me. I'm not here to do that to you. You do not have to take anything. You can do this, period. However, to encourage you to avoid being like so many traders who throw money in and do it, I'm going to offer a program where you can combine these things. And this is what the bottom line would be. Upfront cost is $6,000. You get the full DTS seminar program. Full program, boom. You have not read about it. It, of course, is phenomenal. Here it is. And your buying power on day one, $30,000. And again, this is kind of a thing I'm picturing for somebody who's relatively new. But if you're not, you can take this program and you can add more money if you want to. I mean, every 1,000 you add would be a 10-to-1 ratio that you could increase it. 95% payouts on day one. You're going to get a month in the DTS trading room included as part of this. You get to use the simulator for 30 days, but if you want to, you don't have to. That's a benefit. If you want to say, hey, I want to practice 30 days, you can use the simulator. And there's an educational seminar also on the Sterling platform. Okay? Now, what I'd like to do, folks, I'm going to be fairly strict about this because I want you to understand that this is a company that I believe in that I think could be helpful to you guys, but I'm not part of that company. And anything having to do with the DTS education, I want you to ask me. And anything that would be having to do with specifics about the proprietary part of it, I want you to ask them. Okay? It is for equities, TJ. It is for equities. It is for equities. Now, the way I want to work this is I would like anybody who's interested in this to email me. And just email me to say, Paul, I'm interested, or email with me any questions you have. No, not options. No. But any question you have, ask me. Now, you email me. I'm going to email you back something, asking you a couple questions, and then I will send you the information about this firm, and you can talk directly to them. They are phenomenal customer service. Once you contact them, they will get on the phone with you. They will sit there and help you set up stuff. They will answer your questions. They will do whatever you need. And they're going to make you feel comfortable and whatever else. And there's no secrets, no hidden, no anything. So this, I think, is a good option for some people. Some of you don't need it, don't want it. And I also, again, like I said, you're not required to take the education. But for this package together, I'd almost have to call somebody foolish. If you've not had my program, to not do it, I think is foolish. But it's your option. You know, it's your option. I don't make anybody do anything. And I want you to be encouraged to do it if you do. Okay? That's the total, correct? Yes. If you put up 6K, yeah, you have three of that is going to be the deposit. In other words, yes, that gives you 30,000 buying power, correct? Yes. No, there's no test to pass. You can be trading 24 hours after you fill out the stuff you need to trade out. And again, when I say something like 24 hours, don't hold me to that. I mean, generally speaking, yes, you can be trading almost immediately. But you have to fill out the stuff. There's no problems. I'm saying there's no delay. There's no test. There's none of that. Okay. So feel free to email with questions, or if you're just simply interested, you want to get hooked up with the company, let me know. And again, this is kind of a separate little thing. I think it could be very helpful to some of you. And if there's nothing else, okay, guys, have a great evening. We'll see you later.